Welcome to Early Edge Club. Before we deep dive, we are opening Early Edge Club to a small cohort of serious microcap investors. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Today's section is divided into understanding first the business model, the industry, and then we use our 20 factor scoring, and finally our take on valuations and risk. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
Pix Transmissions Ltd is a leading manufacturer of belts and related mechanical power transmission products. The product portfolio includes industrial belts, agricultural belts, lawn and garden belts, automotive belts, high power rated belts, powerware products, and various accessories. The revenue breakup is as follows. It composes of 52% exports and 48% domestic sales. So the management overview is as follows. The chairman and MD is Mr. Amarpal Sethi, and there are two other joint managing directors, which include Mr. Sonepal Sethi and Mr. Rishipal Sethi. Now the board composition is as follows. There are 14 directors in the company, with 7 independent directors and 5 related family members from the Sethi family and 2 other related family members, which are also promoters. So it's 5 plus 2 family members. So it's basically a family-run business with independent governance oversight. Now the main question is like why a 2000 crore market cap company is requiring 14 directors? That sounds too much, especially considering their salaries. That will come to later. So coming to the industry analysis, the rubber transmission belt industry enjoys high entry barrier due to capital intensity, technological expertise, and specialized product engineering. There is rising global protectionism and tariff wars, which are emerging as a latent risk for export-heavy component manufacturers like PICS. But despite these geopolitical shocks, industrial manufacturing tailwinds like rising localization and weakening INR offers long-term tailwinds for the sector. So the peer analysis is as follows. So considering the PE part, so Pix Transmission has a much lesser PE as compared to other participants in its industry in the rubber manufacturing segment. Also in year-on-year quarterly sales growth, the company has posted really good numbers as compared to its peers. Only Modi Rubber has got a better number in year-on-year quarterly sales. However, considering all parameters including ROCE and ROE, it beats all its competitors in every parameter combined. So that way it's well positioned
Are they,
compared to its peers.
sorry, are they all belt transmission product company?
So exactly that's what I'm mentioning, that they're rubber manufacturers.
Then don't compare like
They're
that.
manufacturing industrial products but not exactly belts.
Yeah, then that would not be the right comparison of peer.
Yeah, that's true.
Okay, yeah, go ahead.
So, future outlook and insights is as follows. Analysts expect a sustained 8 to 10% revenue CAGR driven by exports, cost efficiency, automation, and a well diversified product and geographic mix. These analysts are basically the credit rating agencies who have given their outlook on the company's financial standings. Also, the 36% PAT growth which the company experienced this year, and they have also got very high cash reserves. This reflects the management's strong execution during a volatile macro environment arising out of tariffs, considering 52% of the company's revenue comes from exports. Also, tariffs and geopolitical risk acknowledged by the management may act as near-term headwinds, but they are not structural threats. Companies diversified among various countries. The bull case is as follows. So the export witness growth of approximately 30% as compared to FY 2024. So if this trend continues, the company is expecting much better results. Also, there is a favorable export mix with weak INR and increasing margins, which can push profitability much farther. Also, as global players diversifying their sourcing, so PTL becomes a China plus one beneficiary, lifting its global order book and brand equity. Also, PTL commands a stronger balance sheet and higher profitability margins than most domestic listed rubber component manufacturers, which we already have seen in the previous slide. Also, the focus on automation and green energy can yield great returns for the company if executed properly. The company has spent around 30 to 50 CR on maintenance and automation capex, and around 30 CR on a solar project for the company's internal green energy requirements for captive consumption. Now, the bear case is as follows: a cyclical slowdown in industrial demand, the tightening tariffs, or sharp INR appreciation can compress the company's export volumes and margins. Also, the company has got limited presence in OEM automotive segment, which restricts PTL from tapping into the larger scale orders compared to its peers. So basically, industrial belts are mostly used in automotive sector, and the company is not there, so that poses a challenge. So, failure to scale or diversify beyond the industrial bill segment may lead to growth slowdown. The 52% of the company's revenue is derived from exports. Also, 30% of the raw material requirements are also imported from outside. And they have got 80% of unhedged forex exposure in their balance sheet. So, this can erode profits if the currency markets are volatile in the upcoming time, which is quite likely to happen. Now, coming to the 20 factor scorecard, they do not have any active fundraise history. Their director and promoter track record is good. Sethi family holds around 61.82% of the company, so I give them a 5 here. Now, there are a lot of related party transactions which made me give them a 0. So, firstly, they have got 2 crore worth of rent paid to enterprises in which there is promoter control. These are not subsidiaries, these are entities where there is high promoter control. Also, they have taken and paid back loans worth 2 crore to enterprises again in which there is high promoter control. They have paid 1.7 crores worth of interest to key managerial personnel and promoters. And the outstanding loan from key managerial personnel and promoters stands at around 15.26 crores, which is quite a heavy number considering their revenues. So I give them a 0 here. Now, the board independence and composition is as follows. There are 14 directors with 7 independent directors, 50% independent director, and 36% family on board. And so I give them a 3 here because there is not much like the board composition seems too big, and which is reflected in the CEO and KPM salary, where Mr. Amarpal's salary is around 2.34 CR, which is just 0.4% of sales. However, the entire board salary taken together is 14 CR, which is around close to 2.5% of sales. So it's highly draining their revenue, their profits because of carrying a very heavy board, which I feel is very unnecessary at this moment. So I give them a 3 here. Now the key person resignations are none, so I give them a 5 here. Auditor resignation are as follows. So the new auditor has a tenure till 2028. The old auditor resigned in 2023 due to commercial constraints. And their secretarial auditor also resigned in 2024. So I gave them a 3 here. Auditor opinion and credit rating opinion is as follows. So they have got an unmodified opinion from the past two auditors in the last 3 years, and the credit opinion has improved this year as compared to last year. So we give them a 5 here. Nothing related to regulatory issue or legal issue could be found against the company, and the investor communication and disclosures is not very aptly presented. So they do not have a presentation or a press release, and they don't do con calls. So all informations are taken from their results, annual reports, and credit rating agency opinions. So coming to their business concentration risk, they've got a very wide product portfolio and they export products to over 100 countries, export consumer around 20, so around 52% of the revenue, and domestic sales is around 48%. Now, top 10 customers contribute less than 30%, 35% of the revenue, which is quite good. And the major countries of export include USA, Germany, UAE, UK, and Thailand, with no country contributing over 30%, 35% of the total exports. So I give them a 5 here. Regarding revenue growth versus receivables, revenue growth has been good. There was a dip in 2024. However, the company recovered. This happened because of some supply chain disruptions. Also, they expect a revenue growth of around 8 to 10% per annum in the next 2 to 3 years, and with sustained profitability, according to the analysts. So I give them a 5 year. Now, the operating cash flow by EBITDA is quite good. However, due to high direct taxes and moderate inventory and receivable levels, made them decrease from 98 to 60. But that's not very concerning. So I give them a 5 year. Inventory trends are as follows. So inventory days are very high, and the risk of high inventory days is mitigated to some extent as this inventory has a shelf life of over 7 years. However, the concern still persists. So I give them a 3 year. Cash conversion cycle is too high. On one side, the payable days are decreasing. On the other side, the inventory days and DSO is also decreasing. However, on a consolidated basis, the cash conversion cycle is 176, which has improved but is still very high. So I give them a 0 here. Capex as a percentage of revenue is 3.5% with fixed asset turnover 2 and asset turnover 0.9, which is a bit concerning. Also, return on invested capital is 25, so which is also good. So they have got a maintenance capex requirement of around 30 to 50 crores, and this is also going to be invested in automation. Also, for FY26, they have planned an additional capex of 30 crores for setting up solar plant of 9 megawatts, funded entirely through internal accruals. So I gave them a 3 here because of the lower asset turnover. Now, the debt and interest coverage is as follows. They're almost debt free of 0.1 debt to equity ratio, and interest coverage is 35. So that's good. I gave them a 5 here. Liquidity position is also good. There's a difference between current ratio and quick ratio because of they're carrying a bit high inventory, but they have been always carrying high inventory. So that's not a structural challenge since the company sustained so many years of growth. Also, the return on capital employed and return on equity metrics are quite good and they're improving with time. So that's something to be noted. So that I gave them a 5 year. And revenue growth and PAT growth has been consistent over the past 2 to 3 years. Revenue growth has been still small, but they're expanding their margins, which has resulted in high PAT growth. So that's a good sign. Now, the overall score comes up to 34 out of 50 in governance and promoter behavior and 41 out of 50 in financial health, summing up their score to 75 out of 100 overall. Now, coming to their valuation analysis.
So basically, the score is
Usually,
low. Yeah, the promoter score is low because of the related party transaction which you highlighted, and there's no investor communication and disclosure, and a bit here
yeah,
and
and
there.
also the board is drawing a very high salary.
Yeah. Anyway, the reason I wanted to highlight this is yes, this is the case, but one of a prominent PMS is having this stock in their portfolio, Solitaire PMS. So just wanted to understand would like to dig a bit deeper as well. Basically, regarding the business, these are the kind of bells that these are the different belts that are being manufactured by Pix. So basically construction belt, molded belt. They also, and they focus exclusively on the replacement market and branding their belt and selling. They don't supply to OEM for a specific reason, is because their margins get compressed. It was an interesting note that I read from Solitaire PMS, where they spoke about not compromising on short-term growth and having a long-term vision, and they feel that the management has that long-term vision to go a few years of pain to build a brand as replaced. And one other good thing is the applications. They are supplying belts to a lot of industries. And if you see any of the machines that these industries,
Yeah,
especially
yeah.
meant industrial, etc., where these belts are worn, they have to be replaced immediately. Otherwise, the downtime that this machine causes, the loss is much more expensive. So they would want a reliable supplier. So that is a moat that Pix has been slowly building. Regarding the valuations, now giving a brief overview of my understanding and my research, the PE looks reasonable at the current market price is just 18%, and the replacement market is compounding. A lot of investment activities is taking place, etc. We just run the smart analyzer tool, and they have been steadily growing, I would say. So 15 to
Sir, did
18.
you read anything about the 1% growth last year? Because I could not find much data related to it.
Pardon?
Did you read anything about the 1% revenue growth last year? So the revenue growth took a dip last year. So what was the exact reason behind it? I could not find. So the
Okay.
management mentioned there were some supply chain challenges and all that, but it's not very clear.
Yeah, so I didn't read about it. This investment note I read in 2025, so they didn't highlight that. So one of the reason generally most of the companies speak is because in 2024 we had election year. It was an election year, so the capex spending and the industrial output was a bit lower in the first half of the year. So a lot of these industrial companies reported a slower growth, but then once that has settled, it has led to a higher growth. But overall, this is a company that is completely linked to heavy industry growth rate, and these products are recurring in nature because there is high wear and tear in these bells. So let's conservatively take that they're able to grow at the worst case scenario, and very beautifully because of their branding they have been able to increase their margins from 17% to around, I would say, 22, 24, 28 in some cases. I would normal, let's see, at 22.45 and a 15 PE, which is the median PE. The price target is 1110. Italy trading at 1154. So on a worst case basis, this looks a bit expensive currently, but then again we have taken the worst case P. Let's try to we have taken the worst case margin. Let's try to increase the margin to around more normalized level of 25. In this case it is 1249. So yeah, since there's no con call, there's no guidance from the management, very difficult to take what growth rates they are for. But any which case, let's take a longer time frame in horizon. One good thing, few good things I've noticed from the financials are their operating cash flow. High conversion is happening. Basically, a profit before tax is almost getting converted. So let's just take the free cash flow in this case to be conservative. Generally we take, I do know, like for microcap we take operating or the PAT, but since it's already generating good cash flow, let's take the free cash flows for our calculations. Though the cash conversion cycles are high, it's because of the higher inventory, but then coupling with higher operating cash flow, the increase in inventory is not very massive, so it is very manageable. And as you said, it's not a product that has a shelf life or anything. So let's take a discount. It's more of a slow growth, so let's take a discount required return of 20%, terminal growth rate of 3, and 5 years time horizon, and 5 years PE of 15. So the implied growth rate has to be 24 or 25% compounded. This is a more accurate number than previous estimates because we are using free cash flows. So we are being very stringent with the companies. The moment you use PAT or operating like we use in the other companies, these fall. So you can take this as more realistic or the actual way how we have to calculate the cash flow. So this I've taken operating cash flow, now it has fallen to 20%. And if your time horizon is longer, this again falls down to 15%. That's what the company has delivered. And if your return expectations are 15, which means your investment doubles in once in 5 years, then again the implied growth rate falls down. So based on your time horizon and your research and analysis, time your investment is what I would say. Any closing comments?
The company has been posing good numbers, and but yeah, a lot of people have raised questions regarding their managerial remuneration. It's
Hmm.
also up there. A lot of people have discussed
It's a
regarding
problem.
managerial remuneration in value as well. So yeah, people are
Yeah,
a bit,
that I agree.
skeptical about it. It's not they're flagging it, but they're saying that why do they need to do this and that.
I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye bye.